Welcome, curious minds. Today, we're going to embark on a bit of a deep dive. We're looking at the recent UPS second quarter 2025 earnings call and the press release that came with it. Our mission, like always, is to really cut through all that dense corporate language, pull out the key nuggets so you can understand how a giant like UPS is actually steering through this, well, pretty rapidly changing world we're in.
And I think what makes this one so interesting, it isn't just the numbers, the financials. It's really about understanding the strategic thinking, the actual maneuvers UPS is making.
Right.
Things like, reacting to global trade policies changing, shifts in how we all spend money, and also sorting out their own internal operational challenges. It's quite the balancing act for a company that size.
Okay, so let's start with that snapshot then. The performance basics for Q2 2025. What did they report?
All right, so consolidated revenues were $21.2 billion.
Okay.
Their adjusted operating profit, that came in at $1.9 billion. And adjusted diluted earnings per share were $1.55?
Which gives them, what, an adjusted operating margin of?
8.8%. But it's worth just quickly touching on the adjustments there.
Yeah, good point. The GAAP versus adjusted difference.
Exactly. So the GAAP numbers, the official accounting ones, included a net charge of about $29 million. That's like 0.04 per share.
Okay.
That was mainly $57 million in costs tied to their transformation strategy. But it was partly offset by a couple of things. A $50 million gain from selling off a piece of their supply chain solutions business and a $13 million tax benefit. So, yeah, the adjusted figures, the ones we started with, they really give you a clearer view of the core business performance, kind of stripping out those one-offs.
Got it. So those are the numbers, but paint the picture for us. What kind of environment was UPS actually operating in during Q2? How did those big macro trends play out?
Well, it was definitely challenging. They mentioned that even though the overall U.S. economy held up okay, the U.S. small package market specifically felt the pinch. Consumer sentiment was apparently near historic lows. Yeah, and what's really fascinating, kind of paradoxical actually, is this shift they saw in consumer spending. For the first time in 3 years, people spent more, relatively speaking, on discretionary things like restaurants, cars, than on essentials. So UPS described it as consumers trading down while at the same time splurging. It's like maybe you buy cheaper groceries, but you still go out for that nice dinner.
That trading down while splurging thing, I feel like we can all kind of relate to that weird dynamic, can't we?
Absolutely. And on top of that, U.S. manufacturing activity was still pretty soft, which, obviously hits industrial shipping volumes.
Okay, so that's the domestic picture. But internationally, you mentioned trade policy. Tariffs seem like a huge factor this quarter. How did UPS frame that?
Oh, very directly. They basically said trade follows policy, and tariffs are, generally speaking, bad for business.
Not exactly a surprise, but how bad?
Well, they gave a specific, pretty stark example. Their most profitable trade lane, China to the U.S.
Right.
Average daily volume on that lane plummeted by 34.8% in just May and June.
Whoa, nearly 35% drop.
Yeah. And they linked that directly to increased tariffs and also the elimination of what's called the de minimis exception. That was the rule, letting small, low-value e-commerce stuff come into the U.S. duty-free. Suddenly, that $50 gadget from China faces taxes it didn't before.
Okay, that China-U.S. drop is huge. So how does a company like UPS, with this massive global network, actually adapt? Are they just taking the hit, or can they shift things around?
That's where their integrated network really shines, you see. They can adapt. So while China to U.S. volume tanked, volume from China to the rest of the world actually jumped up by 22.4%.
Interesting pivot.
Exactly. And they also nearly doubled their shipping capacity between India and Europe to meet export demand there, so it shows that agility. Plus, nearly 90% of their cross-border transactions were processed digitally. That helps efficiency.
And are they helping their customers navigate this tariff mess?
They are. They mentioned doing over 600 supply chain mapping assessments for customers just this year, helping them figure out the tariff impact, maybe explore nearshoring, moving production closer.
Right, bringing it closer to home, or at least closer to the market.
Yeah, and speaking of nearshoring, they highlighted their ongoing acquisition of Estafeta, a Mexican logistics company. That signals they're still pretty bullish on Mexico. And that whole nearshoring trend, especially for that, $99 billion international small package market, they're not just reacting, they're actively repositioning.
Okay, so reacting to external stuff, but also making big internal moves. Let's talk about the Amazon glide down. That's a term we hear a lot. What exactly does that mean for UPS?
Right, the Amazon glide down. It's It's a very deliberate strategic choice. UPS is trying to improve what they call revenue quality.
Meaning higher margin business?
Exactly, shifting the mix of their U.S. business away from just massive volumes of potentially lower margin Amazon packages.
Hmm.
They actually said the volume decline from Amazon was a bit less than they expected in Q2 because UPS decided to hang on to certain desirable Amazon volumes, probably packages that fit better into their network already or had better margins. It's them saying, we want a more diversified, profitable business, not just be the default carrier for one giant. It's a calculated move.
And that ties into this huge network reconfiguration effort, doesn't it? Closing buildings, changing operations.
It absolutely does. It's massive. They closed 74 buildings just in Q2.
74.
Yeah. That brings the total to 155 operations closed so far this year, and they said more are coming in the second half of 2025. It's a serious reshaping of their physical footprint.
How's that impacting their workforce? Must be tough.
Well, they did mention one interesting, maybe unexpected outcome. The attrition rate, people leaving voluntarily for operational roles, was actually lower than they planned for.
So fewer people left than expected when buildings closed. Seems like it. Which, counterintuitively, led to higher expenses in the short term because they had more staff than budgeted during those closures. They expect that to normalize, though, especially for part-timers, predicting like a 25% attrition rate by the third month after a closure.
Okay.
And for their full-time drivers, many long-term employees, they introduced a new voluntary separation program, kind of a managed way to adjust staffing levels.
Makes sense. They also talked about this Efficiency Reimagined program, redesigning processes.
Yeah, looking at things end-to-end to find savings. A concrete example they gave was a new digital-first global payment strategy, trying to streamline how money moves across their whole operation.
And automation.
Yeah.
Still pushing forward there.
Definitely. They said 64% of their volume now goes through automated facilities. That's up from 60% last year. So that steady investment continues, aiming for that long-term efficiency gain.
Okay, but efficiency.
Right.
Let's talk about Ground Saver, their cheaper ground option. How's that performing, and were there any financial hiccups this quarter? Right, Ground Saver. So they took pricing actions there, made it more expensive, which led to a 23% drop in volume year over year. Again, showing they're prioritizing profit over just sheer volume.
Okay, so less volume, presumably better margin.
Well, that was the plan. But they actually flagged an unexpected hit of about $85 million in Q2 related to Ground Saver.
$85 million. Why?
Because the computer model, the algorithm they used to predict delivery density, it didn't quite match reality.
Meaning
They ended up making more individual delivery stops for those Ground Saver packages than they'd planned for. More stops equals less efficiency, higher cost per package.
Ah, okay. So the model didn't capture how spread out those deliveries would actually be.
Precisely. So to fix that, they mentioned they're re-engaging with the U.S. Postal Service. USPS has new leadership, apparently has some excess capacity, so they're exploring solutions there, maybe leveraging USPS for some of those more scattered deliveries.
Interesting collaboration potential there.
Could be. But despite that Ground Saver issue, UPS was very clear. Their overall expense reduction target for 2025, that $3.5 billion goal, is still firmly on track. They're confident they'll hit the big savings number.
Okay, so despite some bumps, the overall cost-cutting plan is intact. What about the flip side? Where are the growth areas, the bright spots for UPS?
Healthcare logistics. That was a major focus.
Yeah.
They described it as an $82 billion addressable market. Huge potential.
$82 billion. Wow.
Yeah. And UPS's stated goal is ambitious. Become the world's #1 complex healthcare logistics provider.
Complex meaning.
Things needing very specialized handling. They're already leaders, they say, in radiopharma logistics globally. That's moving radioactive materials for medical use. Very tricky stuff.
Definitely specialized.
And also top U.S. integrators in cold chain cross-stocking, basically.
Right.
Managing temperature-controlled shipments for sensitive medicines as they move through warehouses and distribution points.
And I think I saw they're making an acquisition to boost that.
You did. The planned acquisition of Ann Lauer Healthcare Group that's specifically aimed at boosting their cold chain and pharmaceutical transport capabilities in Canada and the U.S. A clear strategic investment in that high-value sector.
Okay, healthcare is big. Any other growth areas, maybe more on the tech or digital side?
Absolutely. They pointed to strong growth in their UPS digital subsidiaries. You've got Roadie, which does same-day urgent delivery using a crowdsourced network.
Like gig economy for delivery?
Kinda, yeah. And Happy Returns, which makes product returns easier for online shoppers, box-free, label-free drop-offs. Revenue for those digital units was up 26.4% year over year.
Pretty strong growth.
It is. And their broader digital access platform, which connects various shipping tools and partners, is now serving over 7 billion shippers. So tech is definitely a key part of their growth strategy, reaching customers in new ways.
So if you pull all this together, the network, the specialized services, the tech, what are the core advantages that let UPS handle all this volatility and still chase growth?
I think it boils down to a few key things. One, that truly global, end-to-end integrated network. It gives them flexibility when trade routes get disrupted.
Right, the ability to pivot we talked about.
Exactly. Two, highly differentiated capabilities. Things like special handling for healthcare, using RFID tags for better tracking, those innovative return solutions, stuff that adds real value beyond just moving a box.
Sets them apart.
Yeah. And three, critically, their ability to actually gain market share in these valuable segments, like healthcare, even when the overall market is kind of sauced. It shows their strategy is focused and they're executing on it.
Okay, now let's get to the outlook. This was a big point of discussion. UPS decided not to give forward-looking revenue or operating profit guidance for the full year 2025. That seems unusual for a company this size.
It is pretty significant, yeah. And they were quite open about why. They laid out several major areas of uncertainty.
Like what?
First, trade policy. Just huge unknowns around the August 1st tariffs and whatever happens with the China tariff agreement review on August 12th. Big question marks.
Okay, trade uncertainty. What else?
Second, consumer demand. How will consumers react to these trade policy changes? How will it impact spending? Especially for small and medium businesses, UPS mentioned they could face a potential 55% cost increase on sourcing from China depending on policy outcomes. That's a massive variable.
Huge impact potential for SMBs.
Definitely. Third, peak season. Their big customers haven't submitted their plans for the holiday rush yet, so forecasting demand for their busiest time is really difficult right now.
Makes sense. Hard to plan without knowing peak volumes.
And fourth, those internal costs we discussed. While they're on track for the overall savings goal, that lower than expected attrition rate, and the extra costs from ground saver delivery density, they just add variability to the short-term cost picture.
So a confluence of external and internal uncertainties making forecasting just too difficult right now.
That's the message, yeah. Too many moving parts for reliable revenue or profit guidance for the full year at this point.
Okay, but despite pulling that guidance, what about their financial commitments? Capital spending, dividends, buybacks, did they stick to those plans?
Yes, absolutely. That was a key point they made. Even with the uncertainty on the top and operating lines, they confirmed their 2025 capital allocation plans. About $3.5 billion in capital expenditures, investing back into the business. Around $5.5 billion in dividends paid to shareholders. And they've already completed the planned $1 billion in share repurchases for the year.
So, still committed to returning capital and investing, even amid the fog.
Exactly. It signals confidence in their underlying financial strength and long-term strategy, even if the next few quarters are hard to predict precisely.
So, summing up the outlook, it sounds like they hope things will be clearer by the end of Q3, maybe allowing for some Q4 guidance.
That's what they indicated, yes.
Yeah.
They expect more certainty then.
And despite the current volatility, the underlying message seems to be confidence that the big strategic moves, the network changes, the efficiency drives, the focus on areas like healthcare are setting them up for better long-term performance and a stronger competitive position.
It's precisely it. This isn't just about weathering a storm. It's about fundamentally reshaping the ship.
Yeah.
Proactively transforming the business to be more resilient and better positioned for the future, whatever it holds.
It really has been a fascinating deep dive, seeing these profound shifts happening at UPS, managing that huge Amazon relationship, physically reconfiguring their network, adapting on the fly to global trade changes, and really doubling down on growth areas like healthcare. It's a company in serious motion.
It really is. And maybe here's a final thought to leave you with. The global economic and trade picture is definitely murky, highly uncertain. But watching UPS take this proactive, quite agile approach to fundamentally transforming its own operations, it really shows that strategic adaptation isn't just a reaction. It can be a powerful tool for building long-term resilience and growth. So maybe think about how the lessons from UPS navigating this complexity might apply elsewhere. How do large organizations, or even smaller ones for that matter, truly thrive when things get volatile? It suggests being nimble, even when you're a giant, is key.
That's a great point to ponder, being nimble even at scale. Well, thank you for joining us on this deep dive today. Keep exploring, keep connecting those dots and whatever interests you, and we will catch you next time.